Next, Hive harmonic trading patterns every pro trader uses. Learn to identify and trade them.
Welcome back to the deep dive. Today we really need to talk about something that honestly sounds a little bit like magic. And I don't mean the pulling a rabbit out of a hat kind. I mean the seeing the future kind.
It does sound a bit mystical when you framed exactly like that.
Well, I mean, think about how most people trade right. It is essentially like driving a car using only the rearview mirror. You look at a chart, you see a trend line that already formed, or maybe a moving average that is reacting to price action from last week. It is all reactive. You're basically chasing the bus after it has already left the station.
Right. And that is the fundamental problem with standard technical analysis. It is entirely lagging information.
Yeah.
By the time the signal actually confirms, the move is often halfway over.
Exactly. But the research we have today, specifically advanced technical analysis, key insights beyond indicators, and that massive guide, 5 harmonic trading patterns. Every pro uses it, claims to flip that script. It is talking about predictive trading, using pure geometry to pinpoint exactly where a price will turn before it actually turns.
That is the promise of harmonic trading.
Yeah. But I have to be the skeptic here for just a second, because when I hear predictive, my alarm bells go off. It sounds like crystal ball stuff. Are we really saying we can predict the future price of a stock or currency? Or is this just horoscope reading for finance bros?
That is a completely fair skepticism. And if you approach it as fortune-telling you are going to lose money, fast. Think of it less like a crystal ball and a lot more like engineering. If you build a bridge, you know exactly how much weight it can hold before it snaps, right? Not because you're psychic, but because you understand the physics of tension and structure.
Okay, so we are looking for the structural breaking points of the market.
Precisely. Harmonic patterns are about identifying the natural rhythm or the structure of market psychology. When a stock shoots up, eventually people take profits. When it drops, bargain hunters step in. These waves aren't random. They tend to follow very specific mathematical ratios.
And this is where the Fibonacci stuff comes in, right? Because the source material talks heavily about this Fibonacci backbone.
It is the DNA of the whole system. You know, the sequence 0, 1, 1, 2, 3, 5, 8.
Right, the code found in pine cones and seashells and galaxies.
And apparently in the S&P 500. The key isn't just the numbers themselves, but the ratios between them. The big one is 0.618, the golden ratio. In harmonic trading, we aren't just looking for a general pullback. We're looking for a pullback that hits exactly 61.8% of the previous move, or 78.6%.
See, that is the part that trips me up, the exactly part. The sources mention a tolerance of like 10 pips or 10 basis points. That is incredibly precise. In the absolute chaos of the market with millions of people buying and selling, why would the price stop on a dime at a specific decimal point?
There are two schools of thought on that. One is the natural law theory that human crowd psychology naturally moves in these waves just like ocean tides. The other is simply the self-fulfilling prophecy.
Ah, because every single professional trader is watching the exact same 61.8% level.
Exactly. If Goldman Sachs and hedge funds and algorithmic bots all have massive buy orders sitting at the 61.8% retracement, guess what happens when the price hits it?
It bounces.
It bounces hard.
It bounces because the wall of money is there.
Oh.
Okay, that makes perfect sense. So our mission today is to decode the 5 specific patterns from the text that use this math. We have got the bread and butter patterns, the extremes, and the outlier.
Let's do it.
Let's start with the bread and butter, the classics, the Gartley and the bat.
The Gartley is the grandfather of them all. It dates back to H.M. Gartley in 1932. He wrote about it on page 222 of his book, which is actually why you will sometimes hear old cool traders call it the Gartley 2222.
Oh, that's where the 222 comes from.
Yeah.
Okay. And visually, for those of you listening, without a chart in front of you, describe what we are actually looking at.
Imagine a lightning bolt. That is your first move. We call it the X to A leg. Big surge up. Then the price needs to rest. It pulls back. That is the A to B leg.
Like a runner stopping to catch their breath.
Exactly. Now here's where the strict math kicks in. For a Gartley, that runner has to retrace exactly 61.8% of the distance they just ran. It is a deep breath, but not a total collapse.
Okay, so X to A is the sprint, A to B is the breath. What happens next?
Then you get a smaller move back up and finally a drop down to point D. Point D is the magic spot. It is the pattern completion zone. In a Gartley, this point lands exactly at 78.6% of the starting move.
So if I see that M shape forming on my screen and the math lines up perfectly at 78.6%, that is my buy signal.
That is where the probability shifts heavily in your favor.
Yeah.
But you do have to be careful. The Gartley is great, But the source material actually suggests the second pattern, the bat, might be even better.
Yeah, the text explicitly calls the bat more accurate. Why is that? It just sounds like a variation of the exact same M shape.
It is a variation developed much later by Scott Carney. Visually, it looks similar, that M or W shape, depending on the trend. But think of the bat as a much deeper, much more dramatic correction. Remember the runner. In the Gartley, they take a standard breath. In the bat, the pullback at point B is shallow, only 38.2 to 50%. But the final drop to point D is huge. It goes all the way down to 88.6% of the initial move.
Whoa. So the price almost comes all the way back down to where it started.
Almost. It
Yeah.
essentially double bottoms, but stops just short.
If I am watching that live on a chart, that sounds terrifying. It looks like the trade is completely failing. The price is just plummeting back to zero.
It does look scary. But that is actually why professionals love it so much. Because the entry is so low at that 88.6% mark, your line in the sand or your stop loss goes just below the starting point X.
I see. So you are risking a tiny, tiny amount of space on the chart.
Exactly. If it breaks X, the pattern is dead and you get out with a scratch. But if it reverses, you catch almost the entire swing back up. The risk to reward ratio on a bat is phenomenal.
So the bat is basically for catching a super deep retracement with a really tight leash.
Correct. It is fantastic in trending markets where you miss the first massive impulse move and you are just waiting for the market to give you a second chance at a great price.
Okay, moving on. Those were the bread and butter corrections. Now we get to the extremes, the butterfly and the crab. These names are getting wilder by the minute.
And so is the price action. With Gartley and the bat, we were trading inside the previous range. With the butterfly and the crab, we are trading extensions. We are going out into uncharted territory.
So this is when a stock breaks to a brand new all-time high and everyone on TV is cheering.
Everyone is cheering. The news is totally euphoric, and the amateur traders are piling in because they have massive FOMO, fear of missing out.
And a harmonic trader is doing what? Looking to short it?
Looking to short the exact top. It is what we call an exhaustion pattern. Imagine a rubber band. You stretch it, stretch it, stretch it. Eventually it is overextended. It has to snap back. The butterfly pattern calculates exactly when that rubber band is about to snap.
How far does it stretch before it snaps?
For a butterfly, the final point D, you get completely crushed. The crab pinches hard. The reversal is incredibly sharp. But if you enter at 140% thinking the move is done and it pushes to 161, you could blow up your account. You absolutely need wider, strict stop losses here.
So Gartley and bat are for safe corrections. Butterfly and crab are for picking tops and bottoms in extreme trends. That leaves us with the weird cousin at the family reunion, the Cypher pattern. The text calls this the outlier. Why?
The Cypher is strange because the geometry is well wonky. In all the other patterns, the points relate to each other in a fairly standard flowing zigzag. In the Cypher, point C actually breaks the low of point A.
Wait, visualize that for me. If point C breaks the low, doesn't that just look like a new downtrend has started?
Yes, and that is exactly the trap. It looks like the trend is continuing down. It sucks in all the breakout traders who think, oh, support is broken, let's sell immediately.
But then it reverses.
It reverses sharply back up. The Cypher is effectively a bear trap or a bull trap. It is mathematically designed to catch those stop hunts.
That explains why the source says it is best for choppy markets.
Exactly. You know those range-bound weeks where the market just can't make up its mind? It goes up, breaks a high, then crashes, breaks a low, then rallies again?
Yeah, a megaphone shape.
Right. Traditional trend traders get absolutely slaughtered in that environment. They get stopped out constantly.
But the Cypher trader loves it.
The Cypher trader thrives there. The pattern has a crazy high win rate, reported between 68 and 73% in the text, specifically because its tight completion zone capitalizes on that false breakout behavior.
So if the market is trending smoothly, stick to your bat. If it is a messy chopping war zone, look for the Cypher.
That is the professional approach, yes.
All right, let's get out of the theory and into the real world. The source material provided two very specific case studies, and I want to dig into them because the devil is always in the details. Let's look at Sarah and the Euro USD Gartley.
Right, so picture the euro against the dollar. It has been trending down. Sarah's looking for a bounce. She spots that W shape, forming a potential bullish Gartley.
Now she measures it. Point B is at 61.8%. Point D aligns with 78.6%. The math works perfectly. Does she just click buy?
No. And this is where beginners lose their money. She didn't just blindly trust the geometry. She looked left on the chart. She saw that the 78.6% level lined up perfectly with a major weekly support level from months ago.
Confluence.
Confluence. 2 reasons are always better than 1. But even then, she didn't buy yet.
This is the part I found stressful just reading it. She waited.
She waited for price action confirmation. Imagine watching the live chart. The price hits her level, it could smash right through it. She waits for the candle to close. She sees a pin bar that is a candlestick with a really long tail, showing that the price tried to go down but got rejected hard and pushed back up.
So the market effectively told her we tried to go lower, but we just couldn't.
Exactly. Only then did she enter. She risked $1,500 on the trade.
And the execution. Because getting in is only half the battle. How did she manage the exit?
She used a scaling out strategy. 3 tiers. She didn't just hold out for a massive home run. When the price bounced up a bit to a 38.2% retracement, she took a quick profit on 1/3 of her position.
Putting money in the pocket early.
It reduces psychological stress immensely. Once you bank some profit, you can let the rest ride risk-free. She took another third off at a moderate 61.8% profit target, and then she just trailed her stop loss on the final piece to capture the full move.
And the result was a 2.1-to-1 risk-reward ratio. It sounds almost boring when you break it down like that step by step, but that is the point, isn't it? It is discipline.
Boring is good in trading. Boring makes money. Excitement usually costs you money.
Speaking of excitement, though, let's talk about Marcus and the gold trade, because this was not boring. This was terrifying.
This was the Marcus and Gold XAU USD butterfly. The context here is crucial. Gold wasn't just going up, it was parabolic. Just a vertical green line on the chart.
The RSI indicator was over 80. For you listening, that means the engine is severely overheating, right?
Severely overheating. But here is the thing about parabolic moves. They can stay irrational much longer than you can stay solvent. Everyone else is buying, thinking it's going to the moon. Marcus is looking to step in front of the rocket and sell.
He spots a bearish butterfly.
He maps out the extension. He sees the target reversal zone at $2,170 to $2,180. He has major confluence all-time highs, a big round number at 2,200. And the RSI is showing divergence, meaning price is making higher highs, but momentum is actually falling.
But he still has to pull the trigger on a short while the chart is screaming green.
It takes absolute nerves of steel. He entered the short, and this is the key for the butterfly pattern, he used a wider stop loss.
Why wider?
Because volatility at the top of a frenzy is insane. Prices whip around violently. If he used a tight stop like on a bat pattern, he would have been wicked out.
Wicked out meaning the price spikes up, hits his stop loss, kicks him out of the trade, and then crashes exactly like he predicted.
The ultimate frustration. Being 100% right about the direction, but wrong about the entry timing.
Right. So he gave it room to breathe, and he was right. Gold plunged. He caught the exact top of the market frenzy.
And the payout was massive. He risked $5,000 and made over $14,000 in profit, a 281% return on his risk.
That is the allure of the harmonic patterns. When they work, they really work. But we have to be totally realistic here. I do not want you thinking this is some magic money printer.
Absolutely not. The source material includes a very sobering reality check on this. These patterns fail.
How often?
About 25 to 35% of the time, even absolutely perfect patterns just blow up. The market completely ignores the pretty geometry and keeps right on trucking.
So if I follow all the rules perfectly, I am still going to lose 1 out of every 3 times.
Yes. And if you cannot handle losing crater, you simply cannot be a professional trader. The professional process outlined in the text isn't about avoiding losses. It is entirely about managing them.
Let's walk through that process quickly. It is a 6-step checklist. Step 1 is identification, just scanning time frames and finding the shape. Step 2 is validation.
This is the strict filter. This is where you take out your digital ruler. If that B point isn't exactly at 61.8%, if it is at 55% or 68%, you delete the lines and walk away. Missed by more than 10 pips, throw it out.
Even if it looks close enough to the naked eye.
Especially if it looks close enough. Forcing patterns that don't fit the math is a very common mistake. Close enough is exactly how amateurs lose money. It has to be precise.
Step 3 is confluence, which we talked about. Matching the pattern with support and resistance, or RSI. The text actually notes that 3 or more confluence factors boost your win rate to over 70%. Step 4 is entry. Aggressive with limit orders versus conservative waiting for a confirmation candle.
And then step 5, risk management. Mandatory stop losses. The text is brutal on this point. It says trading without a stop loss is not trading, it is gambling. Tight stops for the wide stops for the butterfly.
And finally, step 6, profit management, taking the money when you actually have it.
Don't get greedy. If the market gives you a nice bounce, take a piece off the table, just like Sarah did.
It really seems like the pattern, the fancy geometric decoding, is only about 10% of the job. The other 90% is just pure discipline and risk to reward management.
That is the secret of structural analysis.
Yeah.
The pattern just moves you from reacting to lagging signals to predicting future zones. It tells you where to look. The trader still has to decide how to act.
So we have covered the what, the how, and the who, but I want to end on the why, because this whole concept still kind of blows my mind.
The underlying structure of it.
Yeah, we are saying that the collective chaos of global finance, millions of impulsive decisions, algorithmic bots, news events, wars, earnings reports, all of that total chaos organizes itself into these neat little geometric shapes that perfectly respect a math sequence discovered in the 13th century.
It is spooky when you zoom out.
It raises a pretty profound question for you to think about. If the market creates these precise geometric patterns based on human psychology, does that mean market movements are actually more predetermined by natural laws than we think?
You know, some people truly believe that because human beings are biological and biology follows Fibonacci ratios in our DNA, our limbs, the shape of our ears, that when we act as a massive crowd, we essentially create a biological structure right there on the chart.
So we aren't just trading money.
No, we are trading human nature, and human nature is geometric. Is the chaos of the market actually just a highly complex order that we haven't fully decoded yet?
That is a wild thought to leave you with. Maybe we aren't predicting the future. Maybe we are just decoding the human algorithm.
It is definitely something to mull over the next time you see an M shape forming on your screen.
Absolutely. Well, that is all we have time for on this deep dive. Whether you are a bat trader, a crab catcher, or just purely curious about the code behind the chaos, thanks for listening. We will see you in the next one.
Thank you for watching. Don't forget to subscribe, and I'll see you on next Bell's Forex video.